part of this conversation should be how you define quant.
It's all changed.
We're about to talk to Cliff Asness, who was really a pioneer in the quantitative investment world. He runs AQR Capital Management, and it has more than $240 billion in assets under management. And we're going to talk about the markets. Are we in a bubble? Are we not in a bubble? And what happens if things go south?
Saying there are bubbles and saying you can make money from bubbles are not the same thing.
Welcome to the latest episode of The Bridge by iCapital. I'm Sonali Basak. I'm the Chief Investment Strategist at iCapital, and today I am joined by Cliff Asness. He is the co-founder of AQR Capital Management, $240 billion in assets under management, and many people know you and AQR as pioneers of the quantitative investing world. We'll talk about the future of quant in the age of AI, but first I want to address one topic that is really, I don't want to say plaguing investors, but a real problem, and it's the diversification problem. In a world where stocks and bonds have become more correlated, how do you diversify? Do you need to diversify?
Sure. Well, first of all, pioneering is a very polite and nice way, and I appreciate it, of saying old. But it's just true. We were early 1990s quant, so we've been doing this a while. We have younger, smarter people to do the modern stuff, so not to worry. Diversification, the way we approach it is our job for many years, and we do this in different forms. Sometimes it's equitized, sometimes it's standalone, uncorrelated to the market, but we're trying to create returns that are not very correlated to the market. You always want to add that to a portfolio if stocks and bonds are negatively correlated. We're greedy. The famous efficient frontier where you have risk here and return here, you always want to move up to the left. So if you find something that's not very correlated, that on average makes money, you want to add that. Is the need a little bit greater when stocks and bonds are giving you maybe a little bit less diversification than normal? I actually think people exaggerate this. A typical 60-40 portfolio of stocks and bonds. Have you ever met someone who actually owns 60-40?
Right, in perfect amounts.
Yes, it's this shibboleth. We all have to use, I think we get sued if we use 50-50.
Right.
We have to say 60-40. But a 60-40 portfolio, stocks are about 3 times more volatile than bonds. Bonds, in their normal form, you can buy a 30-year zero. I'm not talking about that. But if you buy, say, the 10-year treasury, you're mostly diluting equity returns, not diversifying. The direction of bonds doesn't matter. It matters, but not quite as much. So the correlation change is bad, but it's not quite as extreme. Though on net between that and another thing, the fact that we think the stock market's fairly expensive versus history. We're not market timers. We've written a lot at timing the market based on pure valuation. I've tried to do this. It's a suicidal quest.
Well, I think also I've been talking to you now about whether we're in a bubble or not for the last 3 or 4 years.
I have screened bubble twice in my career. And this is a hard thing I was a disciple of Gene Fama, the efficient market hypothesis. He co-chaired my dissertation committee. But even Gene will tell you markets aren't perfectly efficient. He doesn't like the word bubble. But I do think I've lived through 2 in my career. The dot-com or tech bubble at the end of the 90s peaked in March of 2000. I don't want to talk about how young you were at the time, but I was in hell.
It's so funny. We were talking about oldness and stuff. You know, you were just on a podcast talking about how you were doing the Rolling Stones tour.
Yeah.
No, this is the Eras tour. We're going to make you Taylor Swift. We're talking about the new stuff here.
I think I'd rather be Taylor Swift than the 82-year-old Mick Jagger. 80. I saw him at Jazz Fest like 2 years ago. I think he had turned 80. It's freakish how good he is.
Going.
He's jumping around the stage. I'm like, I'd be whining about my back and holding things, and I'm 23 years young.
But you
not a quant topic.
You're not 80, but you've seen the late 90s. And, you know, it's interesting. I've heard you talk about this where you've made it through a currency crisis at that time, but then you ran right into the dot-com bubble.
Yeah. In August of 98, Russia defaulted on its debt. Certainly emerging market currencies were crazy, but the biggest thing was in August of that year, stock market dropped about 20%. And I often describe this as the crash that nobody remembers. People remember like October 19th of 87 when the market fell in the low 20s in a day. And the reason I think people don't remember it is two things. Came back fairly fast, and people remember pain that's long-lasting more than short. Second, it just didn't happen in a day. It was fairly steady over the month. And you never get that newspaper headline,
It's
the
Black
Tuesday after
Monday,
Black
right?
Monday. Exactly. But that first month, we were up. And we were just starting to get invested. And we were a little bitter because we're like, we would have been up a lot if we were fully invested, whatever. But still, we claim to be market neutral. First month of our existence, the market drops like 20% and we're up. So we're high-fiving. It's like proof of concept. I learned a lesson that I think I've been good about since then. Never high-five in this business. You get to high-five once. When you retire and you're like all in safe assets and you're not doing this anymore, you can high-five once. And even that can be a little dangerous because the market gods are listening. Because the next 18 months were the blow-off top of the dot-com bubble. And that was, round trip, I think we made a lot of money. It wasn't a black swan. It wasn't, as geeks would say, a 10 standard deviation event. It was a 2 standard deviation event. But you don't want to have a 2 standard deviation event in your first year and a half in business. You never want to have one.
So you've learned a lot then over the last few decades.
Yes.
Right? This idea of market neutral, you started this conversation about saying that you want to create uncorrelated returns. How do you be uncorrelated in this market?
Let's only talk about individual stocks. We can talk about macro also. It's just simpler to talk about one set of what we do. The simple way, which not everyone does, is if you want to be uncorrelated, start out by being long and short a very similar amount of stocks. If there's a big difference in the so-called betas of the long and the short portfolio, you may want to apply a hedge ratio. But if they're similar betas, if you're long 1,000 stocks and short 1,000 stocks, which is not atypical for us, a typical portfolio for us is global. It is, again, don't hold me to 1,000. There are times it may be a little more, a little less, but it's long 1,000 stocks, short 1,000 stocks, mainly balanced by industry and country. Not entirely, but mainly. So one way to be neutral is to actually take the actions to neutralize the market part, and in fact, a bunch of other parts, the country part, the industry part. It doesn't make it riskless. There are times where you choose what you think are all the right stocks, country and industry neutral, and the wrong stocks win. But we do think it wins on average, and we do think it makes it a good diversifier because you're not as buffeted by all these other things.
Maybe you can bring us behind when you're long and when you're short. You and I have talked about this a lot. I think a lot of people from the outside look at this world and say, oh, well, when hedge funds are shorting, they're making a targeted short. But you're not doing that kind of single stock analysis from where you sit. So what are the qualities?
Yeah. Quant's always non-intuitive to people. The qualities we would look for in a long and a short are relatively symmetric. Not always, but basically the shorts are bad on what the longs are good on. I won't take you through everything. We do some things that are more proprietary today in the world of alternative data, the world of natural language processing, and some of the AI tools. AQR is always published and talk about things, and we still do, I think, more than others. But we've never talked about, if you find something that you think is actually relatively unique alpha, even AQR will not write about it. So I will talk about some of the more publicly known things, but they're still a big part of what we do. The academic literature and the kind of quant Wall Street literature, over time, it has really grown. When we started AQR, you were looking for really two things. And it sounds really simplistic, but it was also the state of the art of the time. You were looking for low multiple, good momentum stocks. Those were the two major findings in academia. The third was that small stocks outperform. We never believed in that one particularly. Low multiple, so-called value stocks, which I think that's a misnaming, by the way.
Right. We can get into value versus growth for sure.
But even if it's misnamed and it doesn't capture all of value, I do think on average paying less is a good thing, and particularly paired with momentum.
Have you seen that meme going around on the internet where people are throwing out the Benjamin Graham book? You've never seen this?
No, but it's an idiotic meme.
I think a lot of
People have
people
thrown out that book to their detriment quite a few times. I don't know how long it'll take, but
people have lost the art of value.
yeah. Well, part of the evolution of quant is ironically getting more like Benjamin Graham. People will quote him and the Graham and Dodd book and his other book, and they'll make it sound like he's the deep value cigar butt, destroyed company, but selling for pennies. And it was never that. It was always closer to what Buffett and Munger talk about. And Buffett and Munger, they are really good about this. Sadly, Charlie has passed, but I don't want to refer in the wrong tense. If you watch those two, I'll go on like deep YouTube rabbit holes where I'll watch these guys. Buffett would credit Munger with changing him from kind of a cigar butt looking for super cheap to looking for good companies at a good price, not at a dirt cheap price. And quant, we had to learn our lesson slowly because a lot of quant, you think of the quote factors that have been added to the quant universe. It was just valuation multiples, not full value, and momentum in 1990. Profitability, measured all kinds of different ways. Risk, looking for low beta, low vol, low earnings variability. Those two things explain more of Warren Buffett's returns than value does. We wrote a paper on this. 3 of my colleagues wrote it. I didn't make it as a co-author, and it's one of our best papers.
Is it the insurance one?
No, they talk about his insurance float in there. That is part of it, because part of what he did was had a pretty ingenious way to finance what he did.
Genius cost of leverage.
Yeah. And everyone says that kind of dismissively, like, that's all he did. And I'm like, yeah, he did it and nobody else thought of it. And he did it for like 40 years. You get credit for that. You don't get to just go, it's like I can go, Jim Simons at Renaissance Medallion. All he did was, he's early to short term. I'm like, yeah, Cliff, you could have done that and you didn't. So I wouldn't say that about Renaissance. People are too dismissive. But the paper said, we know he's not a quant, but let's pretend. We have a return series, and we've done this for other famous investors. There's a series on our website saying if you use the quant factors simply to explain, if you have a style to what you do, even if you're picking individual stocks and owning a concentrated portfolio, if you're looking for reasonable multiples and profitable companies with low volatilities and low betas, you end up pretty correlated to the quant versions. In a given year, if your particular picks do great or terrible, you can deviate, and we explained a lot of his returns. This is very rough, but call it 40% looking for more profitable companies, 40% looking for lower risk companies, and about 20% valuation. So valuation, you think of them all at once, but you can also think of it as a tiebreaker. Not a deep value person, but am I paying a reasonable price? Value gets a say, or multiples get a say. By the way, you've probably heard me say this before, but I don't think the quant should have called low multiples the value factor. It's not. Value is more holistic. The Graham and Dodd people, Warren Buffett, are right. You can have a high multiple company that is value if you think it's going to grow enough, if you think its current profits are gigantic and it's going to grow from here. Low multiple still works because on average people just go too far. But I think of quant, a big part of quant evolution, the less fancy, less modern part, just evolving the factor set, has been getting more and more like a full holistic investment process.
So translate that into today's market, because what we're talking about is how to find different versions of value, if you'll give me that. Because if you look at the market, a lot of people are talking about how, 10 companies making up 40% of the indexes right now, or, the S&P 500 at least, more so, right, when it comes to some of the other indexes. So, but if you split it up, actually, it gets so much more interesting across industries, across size of companies. And so you could argue that we're kind of in this era of pretty extreme dispersion. So what does that mean for somebody like you?
Sure. First, in most of what we do, the concentration of the index does not bug us very much, because if you have 1,000 stocks long and 1,000 stocks short around the world, Equal weight is going too far. We have weighting schemes, but it's closer than say market cap weighting. What 7 stocks are is close to irrelevant. We will bet on those stocks. I generally won't know. If you ask me, which would be very embarrassing if you did right now, what's your position on NVIDIA? I would say we probably have one, but we're quants.
We don't know if it's long or short.
I have 1,000 longs and 1,000 shorts.
Right.
I'm deeply invested in the characteristics that the long portfolio looks better than the short on all the things we care about. And the hedging, that we're not taking giant, like we said, market or country bets, but the concentration in a liquid alt, for instance, does not bother us. In a long only beat the benchmark portfolio, which we also do run, concentration matters in the following way. Negative views are hard to express in a long only. All you could do is not own something. If you have a negative view on NVIDIA, you can express that because it's such a big weight in the index that, for instance, if you don't own it, that's a fairly big bet. If you have a negative view on even the 100th biggest stock in the S&P 500, it's still a pretty big company. Its weight is small, and you can't move the dial very much. And when the market gets concentrated, that effect gets bigger because all the small ones are even smaller. So it does constrain the traditional long-only manager. I don't think it's damning. It just makes it a little harder. I don't think it has hardly any effect at all.
Is it better for you in some ways?
It could be better or worse. I was about to add, it has no effect at all mechanically. And that's the first thing you worry about. Can you make the bets you want to make? If it's indicative of a certain market environment, if it says, this is getting back to your question, is it a bubble? Which you still haven't answered. If it's indicative of a bubble, or if it comes along with a bubblish attitude, that can affect what works and doesn't work. So it might be coincident with things. If you tell me the market got super concentrated and people threw value out the window and the only thing that worked was momentum, I think that's part of the story. So it can say something about the market, but it has not bugged us to date. I will brag for a second. Our versions of value since COVID have been pretty good. That's not genius on our part. I think other quants might tell you a similar story. If you look around the world, value has held up a lot better outside of the U.S. than in the U.S., and we're fully global, which amounts to being about half the U.S. these days because the U.S. market cap is so big. But still, half is a big change. Being industry neutral. We're not sitting there short tech. We're long and short within industries. And if there's a tech crash, like today is a fairly ugly day for tech, I'm going to guess, I haven't even looked, that our versions of value will be trailing the more traditional ones today because we're not really taking that bet. We think it's a higher risk-adjusted return not to take that bet. We think comparing tech to, I'll make up an extreme, to textiles on valuation multiples is a little crazy. There are industries that will grow for a long time different than each other and should sell at different multiples. So all considered, it's been a pretty good time for us. If you look at stuff like the Russell 1000 growth versus value, look, when you're making an index, you got to create something simple, representative, investable. I'm not criticizing, but that takes huge industry bets and is cap weighted. So if you get into a very concentrated market, after that, the things you're concentrated in will drive a lot. So
and a lot of those companies aren't profitable either, right?
And you get into a big short, the Mag 7, short AI bet in value versus growth in the traditional indices. And that is something, again, they'll have their day. And if they have their day, I hope we'll make money, but they'll make more money for a while. But we think those things are really hard to bet on in a risk-adjusted sense. And so we think those indices are really interesting to know what's going on in the market, but they don't give a good indication of what systematic players are doing. Sometimes, I would say at the peak of major bubbles, remember I said there were two and I only got to one. One peaked in March of 2000. The other peaked in, say, October of 2020 after COVID finally started to fade. In both of those, we had a fairly concentrated market that was so crazy that it leaked over into even very diversified portfolios. There was no place, if you cared about price at all, a simple model like, price to earnings, a complex model where you build a whole DCF if you cared about price at all, You were miserable for the last 6 to 12 months before the peak, and then you enjoyed multiple years of happiness.
So if we were in two bubbles in your estimation, in 2020 and 2000, right?
Yeah, those were the peaks.
Those are the peaks. Why are we not in a bubble today?
That's a harder one. I have a high standard before saying bubble. There's enough Gene Fama rattling around in me that I will disappoint him by saying that there are bubbles. I still have enough of him where I don't see him everywhere. I think our industry is a little guilty of saying, oh, that looks expensive, it's a bubble. A bubble to me has to be beyond the pale prices. I've often used this as a subjective assumption. You might come up with you might have a different verdict on a particular bubble than I do, but the framework of can I come up with assumptions that aren't ridiculous, with ridiculous again being a somewhat subjective word, that could justify these prices. And at the peak of the dot-com bubble, I wrote a whole piece called Bubble Logic, where I tried to do it for the NASDAQ 100, and I picked on one stock. It was Cisco Systems, only because it looked very much like the NASDAQ 100, and it's just more fun for people. And I built the DCF, and I said, what kind of growth assumptions do we need?
How often is a quant doing a discounted cash flow?
Well, I
feel like
I
that's
did
not a
study
common-
that and teach it when I was a TA.
But it's normally not the math you're doing.
No, we're not on an individual company, but again, in a more holistic process where you're looking at it doesn't come out that dissimilar. The things that you would look at in a DCF, you would say, what is the price today? What's the growth? And what do I discount? What's a fair discount rate? And if it's riskier, I want a higher return. And is it a good bargain now? And all those things are part of quant models. So modern quant models look more, not entirely, but look more like a very diversified version. It's a grand bet that a DCF works. It's not a bet that a DCF will get any one company right.
So then back to the bubble question. I'm going to hold you
Why
to
is it not
this.
a bubble?
Why is it not a bubble?
Okay. I don't think we're there yet. For one thing, some of it's just mechanical. We measure, and we started doing this in 1999 during the later stages, but not quite the peak of the dot-com bubble. We built something, and I'm quite proud of this because I think we were the first to write about it, that people have come to call the value spread. I don't remember if we called it that in the first paper. Sometimes we're always guilty of looking at history and using today's terminology and feeling like we were calling it that then. But the value spread said this. Believe it or not, all the academic work at that time and all the published work that we had seen, again, I always feel bad. Somebody maybe did it somewhere and we're not giving them credit, but everything we had seen sorted stocks on these measures and then said, do the good ones beat the bad ones? And they didn't ask, well, how big are the differences? If you sort your stocks on price to free cash flow, price to sales, pick your favorite, whatever you like, you will always find some that look cheap and some that look expensive. That otherwise your spreadsheet is broken, right? Unless the price to sales of every stock is suddenly the same. If you sort them, you're going to have a bottom third, bottom decile, whatever you want to do, and a top. But the difference between the expensive and the cheap is not going to be constant through time. So we did really simple things. We took like the 1/3 of stocks that were expensive on various different scales, divided that by the 1/3 of stocks that were cheap. So the price to sales of the expensive divided by the price to sales of the cheap. And we showed how that varied through time. And for a few of the measures, I only remember price to book actually, which we don't give a lot of weight to today, but it's the only one I remember. Historically, for about 50 years, if you did that calculation, it varied between about 3 and 6 times. So when there was big disparities in how the market was valuing things, the expensive was about 6 times more expensive. When they were narrow, it was about 3 times. Never got to no disparity because, again, you're sorting the stocks. And we found that over that prior 40, 50 years, yeah, it was better to own value, not on the next day, but called the next couple of years when the disparity was bigger. At the peak of the tech bubble, we saw that thing hit 12 or 13. So it was one of these, I hope this comes out on camera. I'm drawing a very sophisticated diagram on my hand. It was 3 to 6, 3 to 6, very well behaved.
Then it's shot up to 4 times that.
And that's when you sit there and go, all right, I may be a quant, but let me roll out my MBA skills and say, are there any numbers that could justify 13 times the spread? And the answer we came up with was no. That doesn't make it easy. Betting against a bubble is famously difficult. If anyone gets it to the day, I'll be shocked. If you're 6 to 12 months early and you hold on, you're going to make a lot of money round trip, but it's not a pleasant 6 to 12.
Right, that was the story of 2025. Everyone was so worried about a bubble that too many people didn't actually invest.
Saying there are bubbles and saying you can make money from bubbles are not the same thing.
So where are we now? You were talking about that disparity.
I'm leading up to it. Last I checked globally, that disparity, which hit a new 100th percentile during COVID, surpassed the dot-com, at least the way we measure it. So, and everyone can measure it slightly differently, at least. But most people, I think, found fairly similar results. Had hit a new 100th percentile, the widest ever, so that 1213 was eclipsed. I would jokingly call this the 125th percentile because it was about 25% more than the prior one. It's a math geek joke because there's no such thing. It just makes it the new 100th percentile. But I found it funny. We're about 75th percentile now on our measures.
On the new 100%.
Yeah. If we bet on industries, it would look more extreme. But we don't love that bet. We think that bet is, the growth differences and the risk differences can be very long-tailed there. And that could justify some valuation differences. So we don't trust it quite as much. But the way we and a lot of other quants do it, we find things look wider than normal. I don't think I should scream bubble at the 75th percentile. For me, 75th percentile makes it maybe a better time than normal to own some of this in your portfolio. But it's not screamingly crazy. I can't look at this disparity the way we measure it today in what's most important to us and say this is crazy. And I have said it at least twice in the past.
I was talking to you in 2020. I remember this. You were screaming.
Oh, repeatedly.
You were definitely screaming.
Near the end of 2019, I wrote a piece where we've said market and timing factors like value is an investing sin. And we said it in a joking manner, but we're serious. We say we recommend you sin a little. At true, never before extremes, you can have a little bit more, enough that you think you can hold it if it gets worse, because it's always, no matter what your pretensions, it's probably always going to get a little worse before it gets better. So we wrote a piece saying it's time for a venial value sin. We got a little Catholic there. The more minor sin, not a cardinal sin. Little sin into value. And then I wrote a piece in early COVID saying no sin has ever been punished this violently and this quickly. Things got pretty crazy before COVID. That spread was about its tech bubble peak before COVID. So quants like me who want to blame COVID, that's not fully fair. It was there. COVID sent it to the stratosphere. That's where we got the 125th.
After the Fed stepped in and all that.
All of it. And you remember, you were only supposed to own Peloton. Everything else was that's a bit of an exaggeration, but
No, but a lot of people were owning Peloton then. I remember this.
We will shout bubble. A lot of things make me nervous. I'm enough of a grumpy old man to look at single day options, to look at meme stocks. It's no longer there, but to look at things like MicroStrategy selling for 3 times its worth in Bitcoin, and looking at my nephews, and hopefully they're not listening, I'm just using them as an example, who I'm fully convinced, I won't say my nephews. I'm sorry, guys.
What are they doing?
But, 23-year-old males seem to have both Robinhood and FanDuels on their phone. Yeah. And I'm entirely unsure they can tell the difference. That, stocks on average go up, FanDuels on average you lose.
Yeah.
If you trade too much in either one, you tend to lose. But I think they're just, but all that's me being a curmudgeon. If it's not showing up in the numbers and we're not seeing numbers where I can go, well, this is attractive and I like having this in my portfolio, but I wouldn't call it a bubble. There are other softer signs. Owen Lamont of Acadian, I hope I will actually name competitors I like at times. And I think some people at my firm are like, why are you giving them free press? Because he's great. He's a former academic. He's a strategist there. He has a whole list of kind of criteria as to what makes a bubble. And one of the major ones on the list is issuance. In the other major bubbles we've seen pretty massive issuance. We're just starting to ramp that up. Obviously, the SpaceX IPO was a pretty big frickin' deal.
Yeah.
Prior to that, we had seen a dearth of IPOs for a number of years. So we didn't see another sign of a bubble we did not see is all these companies saying, yeah, we got to sell at these prices. Companies will never say, we're selling because our stock is too expensive. You will hear that 0 times. I won't say. Is there one? Have you heard that? Is there one honest man, treasurer, who says that? It's a hard thing to say.
It's been a long time. The true and tried, Golden Day investor used to look at the Wall Street Journal and look at the insiders' stock sales too. I think that the practice has kind of gone away. Yeah.
So they come up with some other reason. But you do see near the peaks of bubbles, firms selling a lot of their own shares. And we may, look, sometimes.
Something to keep an eye on.
Keep an eye on. Could happen. Doesn't mean it will happen. Things that have happened in the past don't necessarily just repeat. But for me to start shouting bubble, at least in what I do, again, if there's something else someone else does, the overall price of the stock market is very high versus history. It's not .com levels, Schiller capes, but it's getting there. I'm not really talking about that. I'm talking about what quants do.
Yeah.
We see an attractive market for what we do, but we do not. I'm not screaming bubble.
So
I like screaming bubble too. I wanna.
Once in a while, twice now. I hope I'll be there for the 3rd time, and we'll figure out
I
how
actually
to
hope it
navigate
never happens
together.
again. I'm joking about liking it because I have said who the gods would drive crazy, they make first to identify a valuation bubble.
But don't
because
you
you
think
lose
there's
a bunch of money on the
healthy?
way.
Isn't there something healthy about a retrenchment?
Yeah. For one thing,
Not a crash, but a retrenchment.
For one thing, a lot of strategies that have worked for many years that I think will still work would not work if they didn't have these periodic tough times.
It doesn't
that
create
kind of
an entry
flushes out the
point,
market.
Right? You need a new entry point for investors to get in.
And it can't be so easy that everybody does it. And if something is, a too sharp ratio, never lose, that's geek for, super good, almost never loses money. If it's at all publicly known, if it's secret, that's one thing. But if it's at all publicly known, it doesn't last very long at all. If something is a 0.3 sharp ratio, that's a little less than the stock market's been long term. So it's still actually pretty good. It has some horrible short-term periods. And just when everyone thinks, I want this in my portfolio forever, and they're right, actually, to think that, it'll go through one of those periods and flush it out. So there is, for people in my business, be careful what you wish for. If you didn't have these tough periods, what you do might get arbitraged down to nothing. Doesn't mean that I'm not throwing things around my office during the tough periods. I don't enjoy them whatsoever. But I do have these moments of clarity where I go, I wouldn't get to do what I did for a living if it were easy.
Keeps you humble.
And I need that desperately. Markets are very humbling. Warren Buffett, when we studied him, he had horrific 3-year periods, both relative and absolute, tend to be different periods. The market tells you it's hard. It's not impossible to beat. I'm not a perfect, efficient marketer. It is hard to beat. And even if you have a way to win over the long term, the only people, again, I'll use Jim Simons. Unfortunately, he's passed too, but Jim Simons and the Renaissance Medallion Fund. Investors should be careful what they wish for, because you find one of those, they tend to kick you out and only run their own money. My favorite question, I don't get this too much anymore, but every once in a while, over the last 20 years, I'd get a question, is the Medallion Fund better than you guys? And I'd go, oh, hell yes. But I think we're very good and make your portfolio better, and we will actually take your money and they won't. So how is that relevant?
Well, it's incredible, right? Because the next thing I really wanted to ask you about is, back in the day, to get into a hedge fund, you really couldn't, right? It was just the way hedge funds worked. There were these super secret, elite pools of capital, and AQR really has been on the cutting edge of making strategies more available. Now you see an entire investment industry trying to make different types of investment strategies, whether it's private markets or hedge funds, more available to more investors. What happens to the investments themselves as they become more available? Do you think about that? Do you worry about that at all?
Enough capital can ruin any investment strategy. There's no strategy that can just add capital infinitum without affecting what it does. On net, the value spread is only one factor, but we look at a lot of things like that to go, has the net compressed the expected returns going forward. Because that's what you see. If everyone tries to buy the market goes up. The price of the market's more expensive against fundamentals, and we would forecast lower kind of 5 to 10 year returns going forward. The same could happen to us. I would say on net, we haven't seen it yet. Again, it's not a perfect measure, but 75th percentile is not a market where this is all gone. There are a fair amount of people in the liquid alt space who do some similar things to us, but there are a fair amount of people investing in the stuff we don't like. This sounds really obnoxious, but the retail world, I think we're usually on the other side of them. I think they're usually on the faddish stuff, and that's become very popular. So yeah, some parts of the market can grow, but it's the net that matters. And when you look at the actual numbers on the stocks we trade, we're not seeing diminished opportunities. That could happen one day if capital just kept flowing, and every strategy has the seeds of its own, if not destruction, very painful periods when that unravels. I have a running joke at AQR where I pick the youngest person in the room and I go, that hasn't happened yet, but if it does happen, we're probably going to have a great 10, 15 years. Because how does something get arbitraged away? It's people adding capital to what you do, buying what you're long, selling what you're short, and driving up the longs and down the shorts. And you can benefit from those flows for many years. And then I get to retire where people think I'm way better than I am because I was the lucky beneficiary of these flows. And I look at the now young person, then 15 years older, who's now taken over AQR. And I go, the good news is you've won the AQR Game of Thrones. You're in charge. The bad news is I used up all the return forever. Could happen.
One day I'm going to show this to your successor. The reason I asked this also is because I thought you made a really interesting comment that I've never heard you talk about before in a recent podcast about how...
Well, that's rare because I usually say the same things over and over again. So that's nice of you.
This was different. You talked about the other hedge funds in the industry and the risk of crowding. I think this has become a big thing in the minds of a lot of hedge fund managers these days in the current market we live in. Can you explain where your fear comes from?
First, I separate crowding, and this is too binary. There's all points in between, but to just think about it, it makes it simpler. Two kinds of crowding. One we've been explicitly discussing. A strategy with too much capital in it is crunching down the differences between what it's long and what it's short, and can lower the expected return. That's a more long-term thing. That's like saying the stock market's very expensive. We don't know what that means for the next year. We do think the next 10 years you should use at least a more modest forecast. So it's more in that. Crowding can lead to that. Crowding is more typically talked about in the short term, the risk of a very bad short-term event. And that certainly exists. I know you know it well. The mother of all of them was the August of 2007. It was called the quant crisis for about 10 years, and then somehow people switched to Quake.
Yeah.
I remember it as the quant crisis, and at some point people said, we need some alliteration here. Quant Quake is better. This was all of about 6 days. For us, it was very survivable. It was painful. It was just like a stock market crash is painful for a long-only investor. But it was no risk of ruin going on with us. It was just, and we looked and we said, well, my friend, the value spread again went from the 50th percentile at the beginning to the 95th over 6 days. That is a gigantic move in 6 days. But it also makes you think we're going to be fine. We did, in those kind of things, we do a little bit of non-quant stuff, like talking to every dealer, trying to figure out who is taking their positions off. Yet, in some of these...
The sleeves roll up.
Just because we're quants doesn't mean we think all human intelligence is not useful, particularly for something like this. We actually added a little bit to what we did at almost the exact bottom of that, because we heard Goldman Sachs had injected cash into their very, very suffering long-short equity fund, and we thought they were the last kind of weak hand at the time to de-lever. You can de-lever by literally trading your positions down or by adding more cash. And Goldman Partners made out like bandits, of course.
Your alma mater.
Everything came back. I think they did that for the clients, not for because they would make out, but they did do very well on it. Those kind of things, there's not a strategy in the world particularly one that more than two people know about, that doesn't have a bad left tail. And the bigger and the more popular, the worse the left tail, because you don't control your own you control your own actions, but you don't control the actions of people very similar to you. So if someone very similar to you, and we'll all argue we're unique and ours are so much better. So this is a correlation, not the same model. But if someone similar to you and overlapping with you panics and sells, you're going to suffer.
Do you worry about another quant quake?
Yeah, I do. My plan in that is to do what I last did in the other quant quake, along with the other AQR partners and team. Keep monitoring to make sure we're nowhere near a true, event, a margin call. We've never had a margin call. And if so, and we think the strategy's still sound, weather it. We've tried a million ways. And again, you can get someone to come on here and say they've built the system to forecast this. We've never come up with a way that we think can really move the dial of saying it's so crowded you want to get out now. It has the same timing problem of saying it's a bubble, you want to get out now. It can go on for quite a long time. Just because the conditions are there doesn't mean it happens. To get out now is to get out of a good strategy long term because you're scared. I wish I could tell people, yeah, not only do we make money on average over the long term, but we get you out for the crowding months. Doesn't work that way. But we've gotten really good at analytics and knowing where we are. And the worst one ever was an extremely survivable event. Very unpleasant while it's occurring. We've seen mini ones since then. Last year we saw a few. I think one was early in the year. Maybe one was October. I could be off on the months.
Liberation Day, are you thinking?
We saw some craziness. Yeah. Sometimes it is hard to tell whether it's a deleveraging among similar people, which I think was what the quant quake was, right, or if it's just retail buying very expensive, low quality stocks, which quants tend to like. And sometimes it's a mix of both. But by and large, good risk control, where you've looked at the worst cases in the past, you've said, what if it's substantially worse than that? That should hurt. Right? If you say it's the worst case for my strategy and it's worse than that, should hurt. But if it's survivable, if you own equities, you should know that they can go down 20% in a day. And in the GFC, they were down about 60% peak to trough. A lot of good strategies that make money long-term have particularly a short-term left tail that can make them still good strategies. One thing particularly important is when that left tail tends to hit. The two bubbles I've talked about in particular, quant, as we define it, and a lot of other quants too, made money round trip, but when it lost money, everything else was going straight up in a bubble. And when it made more than all of it back was when people needed it the most. And that's not our goal. In those funds, our goal is to be market neutral. We were accidental heroes on that. We didn't want to be so counter-cyclical. But both times it's happened, it has looked that way. So it's not just do you have a left tail. It's both short and long-term left tails. It's when they occur. One thing I'm fond of pointing out, and this is held up for the other mini ones, in the quant quake, peak to trough, the S&P was pretty much unchanged. The world did not notice the 6-day travails of a bunch of quant geeks.
And a lot of your peers were out of business by the end of that.
Some of the more levered ones, I think most common was multi-strat funds that really didn't understand quant, that added quant in a 6-7 year bull market for quant. If it's not really what you do, and this is a self-serving commercial for dedicated quants, I admit, if it's not what you really do, you will be fairly quick to abandon it for bad reasons. And I'd be the same if I did a strategy that was unfamiliar to me just because it had worked for a while. I don't deeply understand it. And when it doesn't work, yeah, I'm like, this is...
So I understand you perfectly here. What is the AQR, the Cliff Asness strategy for the next quant quake? What's the playbook?
The playbook is not to take too much risk going into it. And we take decently less leverage than we used to. We used to run some things we labeled high vol. Literally in the name of the fund was high vol. So we were pretty happy with that disclosure. And it was meant to act this way. But we did say, all right, we survived this one. We're not going to run those again. We are a little more circumspect. So if you saw the full quant quake again, I think it would be less painful to our firm, still not be fun. If you saw 1.5 times it, which would be really extreme, I still think it would be as bad as the last one. I'm making these up. These are guesses. Quants don't like single events. What we want to see is 1,000 quant quakes. So we can tell you this is the histogram of how we do in quant quakes. The humans don't want to see 1,000 disasters. The statisticians want to see 1,000 disasters because then we can maybe figure out what's actually going on. But I think the quant quake, mostly what we do is prepare the portfolios, try to create things. We do more things that are more proprietary now, both alternative data and some of the ML stuff we think looks more different than our peers. They might be very good too. I'm not saying we're the only good ones, but I think the degrees of freedom in those things have led to, in the short term, maybe we may end up looking all alike in 10 years, but in the short term, it's led to some more diversity. We rely a decent amount less on the original factors. The ones I'm allowed to talk about are less of our portfolio. The ones I'm not allowed to talk about are somewhat more.
I was going to say, last question I have for you
please,
is on that alternative data. What can you tell us? Give me some secret sauce. I was a former journalist. I need a scoop.
Well, first of all, no. I can describe what we do in alternative data. Alternative data is exactly what it sounds like. It's databases that didn't exist before, that somebody, often proprietary new firms, sometimes designed just to create this database and to sell it to people like AQR. Sweat equity, if sweating behind a computer screen counts as, if you're sweating, that's
depends on the day in the market.
You probably have other issues. Not that I haven't sweated while looking at a computer screen. So the classic one, about the only one I am willing to talk about, is credit card receivables. It was one of the venerable first ones, and if people are willing to talk about this, it means it's probably largely played out at this point, and probably they're not betting a lot on it.
Sure.
But people built databases that were essentially, this is legal public data. You do have to make sure of that. This can't be an excuse to have data you're not supposed to have. And you actually have to spend some time checking on that to make sure there's not some sneaky data in there that's making it look good.
The collection of the data is the hardest part.
Well, you have things, and like if you're polling experts, if those experts are using data they're not supposed to use, you shouldn't be using it. So you do have to go through some steps. But stuff like the credit card receivable data was just on the web. And somebody put it together, collated it, and it was a pretty darn good strategy. The life cycle of alt data tends to be fairly high risk adjusted return when you're early to it. Again, this example pretty much only applies to retail stocks, right? Credit cards are not that helpful for NVIDIA. Nobody walks in and says, give me 1 million of your best chips, Jensen, and here's my Visa card. But for retailers, knowing who in the last 3 months, I'm making that up, this is not precise, and who in the last 3 months has seen an increase in credit card usage and who has seen a decrease, you can imagine if you have that data a little faster than other people, that's an advantage. But information edges that are about speed, I think are the most arbitrageable out there. Things about valuation and risk, where you're up against huge behavioral biases that people want to believe in 1,000 stocks that are expensive will keep going forever. Enough capital can arbitrage anything away, but that's harder. I'm a little faster than everyone else. It's not going to last that long. So in alt data, often, not always, you tend to see very high risk-adjusted return when you start doing it, and then a steady decrease. It may not go to zero. You may still want it in your model at a smaller weight, or it may really go to zero. The world has figured this out. I had one funny interview where somebody was, the interviewer was asking me about alt data and was not as nice as you. They were pushing for a real example.
Right, give me more.
and I said, I'd love to give you an example, but our heads of stock selection have asked me not to because it is proprietary. And unlike some of the other things we do that we think are fairly hard to arb away, here we'd be helping our own destruction by doing that. When he wrote the piece, very nice guy, a smart guy, but when he wrote the piece up, he didn't say that I was asked not to speak about it. He said, my team won't tell me what we're doing, which has a whole different tone to it. That has a, don't worry, old man. We got alt data. You don't need to worry about it. That is not the case. They, in fact, will tell me. But that world continues to evolve. We've probably thrown out more from alt data than we have from the core factor stuff over our whole history. Measuring it, when you alter a core factor and measure it a little better, have you thrown it out? I don't know. But there's certainly a lot more dynamic change. A few years later, alt data has to be refreshed and replaced with new sources. I can't tell you how many years or decades that will go on for. I will tell you, so far, so good. We've been able to find new sources. Alt data, by the way, is ultimately a form of fundamental momentum. Forever, we've looked at both price and fundamental. We love valuation, we love profitability, but we also like good things to be happening. Simple measures of fundamental momentum that quants have looked at since maybe the 80s, at least the 90s, are earnings revisions and surprises, where they've tended to continue. If you have good earnings, there's often more to come. Alt data is just a way to try to be as quick as you can on those things. So in some ways, it's brand new. And it is in a lot of ways. These didn't exist before. But in some ways, it's just additional ways to measure a theme and something we've believed in pretty much forever.
Okay, truly last question on AI.
I don't believe you anymore, but that's okay.
I know, well, because we went into the data thing, and usually people want to go into the AI
My
thing.
time is your time.
The data part is really interesting as it pertains to quant finance in particular. But on AI, you once said that you had AI taking over parts of your job. How much can it take over, really?
Well, nobody knows at this point. I can tell you kind of where we are today. We've always prided ourselves, and you can't really do this mathematically, but conceptually, being 50-50, does it work in the past, including at-a-sample live trading being better than a back test, but both counting? And does it make sense to us? Do we understand every drop of what it's doing? And do we get the intuition? And the reason you do this part is if you only do what's worked in the past, you're just mining the data. And you tend to grossly overfit. And, you know, the classic examples, if you study 1,000 independent things, one will look 1 out of 1,000 wonderful. Is it really 1 out of 1,000 wonderful? If you find the person who won Powerball, are they good at Powerball, or do they just get lucky? You know, barring cheating, I think they probably just got lucky. So you worry about overfitting. One of the lessons of ML, and my colleague Brian Kelly, and other people like Laura Serbin at AQR works a lot on this. But I'm quoting a lot of Brian Kelly on this. He is a Yale professor and an AQR partner. Great deal you got, Brian. You got 2 full-time jobs that pay you for doing 90% overlapping work. I just want you to know I'm on to you. But he's brilliant on this. And most of the things I say about AI, I'm paraphrasing what he says. So I want to give him credit. One of the things he says, and this is a math concept, it's not an easy one to convey here, so I'll just tell you the fact. Underfitting is a problem on a par with overfitting. We've always been worried about overfitting, that we're going to use these statistical techniques to find random patterns that aren't real, that won't repeat, and bet on them to our detriment. Underfitting is there's actual true complication out there. And you're not picking it up because you're using overly simple models. For instance, we historically have used, when I talk about valuation, and most of the bets are within an industry, aside from a few industries, we recognize things like finance and REITs need some special stuff. But for most industries, we've used essentially the same composite of valuation indicators. Because, yeah, you can say which ones work best in all of 50 industries or 10 sectors. But are they really better? They're highly correlated measures. Price divided by some fundamental. As that fundamental differs, they're still correlated. So you're really going to tell me this one's better, this one's worse? We've also used very simple functions where sort the stocks in an industry by, again, I'll use price to sales, even though we use many measures and average them. Sort them on price to sales. You go long the cheapest, short the most expensive, and it's linear in between, the weights. You add all these up. You have many other factors to come up with a total. Why is it linear? It's linear to avoid overfitting. That if we let models just go crazy and do whatever they want, it's going to catch every little wiggle and it's going to overdo it. But there's no conceptual reason why it's linear. Some factors might work in the tails. Call it the top decile and the bottom decile, but be kind of flat. not give you a lot of information. Some might work on the short side, but not provide a lot of information once you get into the reasonable area. One thing that modern ML is better at than traditional statistics, and it's still statistics, by the way. They're just new, wonderful tools we didn't have before. One thing it is better, we believe, at balancing overfitting and underfitting, penalizing endogenously to creating your model, penalizing overfitting while allowing it to do some reasonable amount. And so things like that, we're still looking at valuation, but ML is building us a subtler valuation model that we think adds to our process. We haven't completely turned ourselves over to it. And again, my phrase earlier about turning ourselves over, I want to defend myself. So this is half a joke, but half true. I often say I slowed us down a little on moving to ML.
Really?
Because you got to give up some intuition when you start using ML. There is usually a stage where you go, I'm not quite sure what it's doing, but it works. And that's something we kind of prided ourselves on not doing forever.
Because you have to, you want to know.
So I think it is the old man at the firm's job when you had something that's worked for 20, 25 years, and you want to have a philosophical change, even if it's a modest one. Again, this is not turning ourselves over. It's going from 50-50 to 2/3, 1/3, something like that. But any change to a philosophy you've stuck with and talked about should be done slowly and carefully. So I don't apologize for it, though I do think I probably cost us a little money by going slow. And we were in a meeting, and I think it was a fairly junior person. I was whining, basically, about this loss of intuition. And the junior person said something like, if it was all super intuitive and obvious, what do you think the machine learning is doing that's special? If there's not a part that's at least hard, and one of the big uses we use for ML is called natural language processing. It's an ML function where you take textual data and you say, is this good or bad news? Fundamental momentum to us. The way quants did this for a trillion years was get the text to the call. We had these digitized 30 years ago, and add up good words and phrases and bad words and phrases with numerical values and come up with a total. So at its absolute simplest, and it's not this simple, increasing is a +1. Obviously, the problem is if the sentence was embezzlement is increasing, +1 was not your best call. Quant can survive that. If it looks stupid 47% of the time, but looks a genius 53, you put a little bit of it in the model. We can live with that. NLP, natural language processing, is better than we are at processing that call, representing that call. This gets very geeky, as a very long set of numbers.
You're telling me where you trust the technology and the data better than yourself, and you're telling me where you trust yourself more than the data. Yeah. That's what you're saying.
The example here, just to finish it out, is there are steps I can't tell you. Like what NLP actually does is represent each earnings call as what's called a vector of a whole bunch of numbers, and then do empirics on those numbers to go which ones tend to be good returns, which ones tend to be bad returns. The intuition, at the end, you create a strategy that is actually fairly decently correlated with other ways to measure fundamental momentum. We just think it's better, or at least very diversifying, adding a very new aspect to it. The correlation gives us great comfort because it means we are measuring what we're trying to measure. But if you ask me this, that vector of numbers that represents each earnings call, what does the seventh number mean? I'm going to be hard-pressed to figure that out for you. And if I turn to a far younger, far smarter AQR employee who's fully up on these things, they're going to be hard-pressed. Maybe they can torture it and figure out one for me. You are giving up a little bit. That's kind of the stage for NLP where I think of that. If it wasn't doing something, you didn't fully understand what's it doing. But I'm almost sure we wouldn't do it if it didn't come out to a strategy that at the end acted very intuitively like we think it's supposed to. When fundamental momentum suffers, measured simpler, natural language processing doesn't have its best time. We think it does better in both environments, good and bad fundamental. We think it's a higher Sharpe, but it looks like the original. That gives us comfort, but you do have to, again, do that uncomfortable thing and say, all right, I'm going to avert my eyes and skip this step, which I think is part and parcel of using ML. Just took me a bit to get used to it.
Cliff, thank you for joining us. That is Cliff Asness. He is the co-founder of AQR Capital Management, and you have been watching The Bridge by iCapital.